Welcome, my name is Eric Martineau, and this is part 2 of a 2-part series about private equity banking and the benefits thereof. In part 1, I spoke about what were the generic benefits of private equity banking. In this part 2, I'm going to show you how to use the basic principles of private equity banking using real case studies. Here are the 6 benefits of private equity banking. First, tax-free growth and tax-free use of your money for life. 2, guaranteed returns with 0 market risk. 3, liquid cash. You don't have to wait until you're old and gray to get at your cash. You can get it anytime you want. The 4th benefit of private equity banking is protection, both from creditors and lawsuits, as well as unpredictable economic events, those ups and downs in the market that none of us control. The 5th, compounded interest. Our money grows. Compounded interest coupled with tax-free growth is a fabulous tool. And then there's arbitrage, the 6th component. Very, very powerful. The ability to have our money working for us in 2 places simultaneously. Can't get that anywhere else, and tax-free. So I'm going to show you how you can utilize this arbitrage to increase your investment. In part 1, I stated that private equity banking is not an investment, it's a tool. What I explain is that there are 3 functions of money. There's the warehousing function, which is where I want my money to be safe. I want no risk. I want no taxes. I want anytime access, and I want guaranteed returns. That, to me, is the banking function of my money. Then there's the investing, which is where, as I just said, you put your money at risk. And then there's the spending portion, where there's an opportunity cost. If I spend my money and it's gone, it's gone. And so there's always an opportunity cost to spending. But since most people understand the difference between banking and spending, where they get confused is between banking and investing. And so in part 1, I stated private equity banking is not an investment because of the risk factor. When I've got my money in a guaranteed bank, I don't consider that risky. So I don't consider that an investment because it isn't being put at risk. I took part 1 and I sent that off to 2 of my mentors, 2 men in this industry that I really look up to. And one of them called me back and he said, "Look, Eric, private equity banking, it's the best investment that there is. You just have to use it properly." So he calls it an investment. The second one emailed me and he said, "I do consider private equity banking an investment, but it's even better. It's a guaranteed investment." Then he added, "But it's a tool as well." Well, I'm going to stick to my guns. I still think that it is a tool, but I'm going to change that to toolkit instead. Let me give an example. A couple years back on Black Friday, I went to Home Depot. I know, don't go to Home Depot on Black Friday. You're going to spend a couple $1,000. And they had this tool set there, right? I could buy all of these tools. Well, I needed both of the saws and I liked both of the drills. And I was like, cool. I didn't know what that last thing was. I'd never seen one of these before. In fact, I don't even to this day know what you call that thing, right? It didn't have the blade connected to it. 2 years later, I go to visit a friend of mine who is remodeling a hotel. And he's got one of these things and he's cutting through drywall and he hits a 2x4 and he just keeps going through it, hits a nail in the 2x4 and just cuts through it like butter. I'm like, that is a cool tool. I need one of those. And I started thinking, wait a minute, I got one of those. As I've thought about some of the people that I've helped get into private equity banking, it's dawned on me that we made it for one specific usage, but I've not expanded that to help people understand other ways that they could use this tool. And so I'm afraid that some of the people that have this tool bag that I've handed them don't understand all of the ways of utilizing a private equity banking account. So I'm going to do that for you today. In Tony Robbins' book, Money, Master the Game, listen right here. Tony Robbins says, "I had an immediate aversion to the words life insurance. Like most, I'd been sold retail life insurance, and I wasn't going to be taken again. And then his attorney said to him, 'Tony, this is not your typical retail life insurance. You can't just buy this off the shelf. Think of this as an insurance wrapper to place around your investments.'" You see, his attorney thinks like I do. This is a toolkit. Private equity banking is a toolkit, a number of tools that you can use to improve or enhance your investments. So I'm going to change my definition from part 1 to part 2. Private equity banking is not an investment. It's a toolkit to enhance and improve your investments. Problem is, like you know, there's no user's manual. Why is that? Remember what Tony Robbins' attorney just said. She said, you can't just buy this off the shelf. Each policy is crafted around your goals, your finances, and your health. That's pretty private, isn't it? So what ends up happening at the end of these things is I have a fiduciary responsibility to make sure that I keep your goals, your finances, and your health private. And so I've built a lot of these things, and I've crafted them around a person's goals, their finances, and their health, but I don't go running around showing people. It's not like as if I sold a solar system to somebody and I can say to the Joneses, hey, look, I just got that for the Smiths. Look at that. I can't do that. So in making this how to use portion in part 2, I'm going to change the names, but I'm going to keep the prospectuses the same. So I'll show you real live illustrations, but please understand, I'm changing the names, not the numbers, to protect those that I've worked with in the past, again, so that their goals, their finances, and their health are not compromised by me by showing you how these folks have utilized these tools. But I hope at the same time, you'll be able to look at it. So let's call this Other People's User's Manual, right? But again, it's changed. Now, in grabbing other people's, let's say I'm using $20,000 as an example. You might be thinking, $20,000? Are you crazy, Eric? I don't get out of bed for $200,000. Why don't you show me examples with $2 million? Or you might be thinking, $20,000? Are you crazy? I could barely do $2,000. Let's do $200,000. I don't care where you're at. If you need to add 2 zeros or subtract 2 zeros from my examples, please understand the examples and the ideas will work whether you add a 0 or subtract a 0 for your financial situation. It's the concepts I want you to see on how to utilize the tools of private equity bank. So what I want to accomplish today is to show you how to get out of bad debt while still utilizing other people's money wisely. 2, how private equity banking can help you outperform the stock market with 0 risk. 3, how you can pay off structured loans with non-structured loans and lower your interest rates. I'm also a loan officer. A structured loan is what I give people anytime they want to buy a home. You have to make that payment on the first of each month. It's a structured loan. But inside of a private equity banking policy, even though you can borrow and use your cash value as collateral, what you borrow from the general fund of the insurance company is a non-structured loan. You never have to pay it back if you don't want to. If you want to make 3 payments in a month, make 3 payments in a month. If you want to make no payments in a month, don't make any payments. That's what I'm talking about. Again, very powerful tool when utilizing private equity banking. The next one, protect your business and your business's assets from the unpredictable and the uncontrollable. Let that sink in. You can get real estate, vehicles, equipment, it doesn't matter. And by owning them, but owning them through your private equity banking account, guess what? They are now protected from the unpredictable and the uncontrollable. I'm going to talk about this one at length. Don't pay cash and drop your savings to 0. Combine lost opportunity cost, which is what happens when we spend our money down to 0. That money is gone forever. We can't use it again. We're going to combine lost opportunity cost with arbitrage. So we have 2 pots of money, one that's always growing and one that we can use to leverage in other investments that as we pay it down, this one has kept growing. Okay? So we're going to use our money twice. Invest in real estate and receive higher rates of return and less risk. I'm a real estate guy. As I said, Diane and I owned 16 rental properties at one point in our life. That was going to be our retirement. And because I didn't have a private equity banking account, I lost all of that. Okay? So I'm going to show you how to invest in real estate, get higher rates of return, and have less risk. Invest in businesses or new businesses. If you're an entrepreneurial person, how to invest in new businesses and get higher rates of return with less risk. Also, build a predetermined, tax-free retirement income for you. A lot of people think life insurance is like, well, I can't use it during my life. It's only good for my family in the future. Not the case with private equity banking. Remember, you can get back to that cash anytime you need it. So if you want to tell me, how you want your retirement income to look like. You know, Eric, I want to take $70,000 out. I want to get to age 65, and at that point, I want $75,000. I want 135. I want 25,000. Again, the numbers don't matter. You can build a predetermined, tax-free retirement income using private equity banking and still have access to that money between now and then. And then lastly, build a predetermined, tax-free legacy for your heirs. You tell me, Eric, I want to have $5 million or $25 million or $50,000. Again, the numbers don't matter. You tell me how much you want to leave to your heirs, and we can build something so that at age 75 or whatever, you're there. You've got that money and you know it's going to your family. I want to give you a user's manual for all the tools that are available for those of us that have private equity banking accounts. So let's look at the first example, a 401k and the stock market. You're going to be able to outperform the stock market with zero risk. Watch this. I already did a video on this. You can go to my website, privateequitybanking.com, and you can watch this video that I've got out there, average market returns versus actual market return. What I've taken here is the Dow Jones and the S&P for the last 20 years. They're averages. And as you can see, 5.76 and 5.6 respectively. When we're talking averages, when you hear your financial advisor talk about, well, this fund averages 8%. This fund averages 11. Oh, we have a high yield and it's at 14%. It averages 14%. What they are doing, this is financial math, is they are taking the arithmetic sum of the gains and the losses on each year and then dividing by the number of years. So if we've got 20 years there, they start with a negative 6.2, then a negative 5.38, a negative 14.5, then they add in a 20.94 and a 3.4. They divide that by 5 and they say this is our average for 5 years. That's a bogus number, and I go through and explain why that's a bogus number in that other video. Watch it. But this, for our purposes today, understand when you hear average from your financial advisor, they're just talking about the arithmetic average across a number of years. And when I showed this to somebody, they said, Eric, we don't want to start in the year 2000. For heaven's sakes, 9/11 happened in 2001, and we couldn't have controlled that. Yeah, that's why we use private equity banking. There's going to be another 9/11. You're not going to be able to control it. And that's the whole point. But for the purposes here, I decided to take the S&P over 30 years so that I could avoid starting in 2021. And I took $1 million and I dumped it into this account. And I know there's many of you out there going, wait a minute, I don't have $1 million to start an account with. What I'm trying to show you is that when you actually put real money into one of these things, that arithmetic average, which right there is at what, 9.5, that is inaccurate. When you put in real numbers and you put your $1 million in, and in first year it drops by 7.1%, you've just lost $71,000. And so the next year you start at 936, right? But that one gains 21%, so you gain $201,000. And so the next year you start at 1,074,000. You get the idea? When you put real numbers into these things, it changes from an average return to an actual return. But to be real honest with people, what your financial advisor usually doesn't talk about are the miscellaneous fees and your taxes. So what I've added in here is 1.5 in miscellaneous fees. Not miscellaneous, really that's what financial advisors want, right? They want money under management. And they get paid 1.5 to 2.5 or more every year for the money under management. In this case, $1 million. You don't get that, by the way, with a private equity banking account. So it's not like money under management. And then you got to have your tax bracket too, so at 25%. So we put it into the real world, put in our taxes, pay them, and then our miscellaneous fees. The actual return that we get at the end of this 30-year period is 5.02. I just got a policy for a gentleman that is offering this year 5.2, right? Now, some of you are saying, I didn't have the $1 million to throw in there. So let's do an example with dollar cost averaging. That means I take $10,000. So say you're just making monthly payments each month and they come out to $10,000 during the year, and I'm going to throw that in there. Well, when you do it that way, the actual return even drops further to 4.78. This is one of my favorite tools in the toolbox. Don't pay cash and go to zero with your funds, right? Your savings. Combine lost opportunity cost with arbitrage. Use your money twice. Now, A couple weeks ago, a friend of mine said, I don't need private equity banking. I can use cash. When I usually hear this, it comes from the Dave Ramsey types. But this gentleman that said it, he actually can pay cash for everything he needs. And in his mind, why would I need to borrow for myself if I can pay cash, right? Well, let me show you. From the book, Pirates of Manhattan. Private equity banking. Banking is the key word. And as Barry Dyke says, money must reside someplace, right? If this guy says he can use cash to buy his toys, where's his money? Money must reside somewhere. When viewed in this light, of all the alternatives, permanent cash value life insurance is perhaps the safest and the most economically efficient holding tank, banking account, of cash savings within America today. So here's my question for my friend. Where is that cash not warehoused just before you invest it? You're going to pay cash for that boat. You're going to pay cash for that car. You're going to pay cash for that airplane. Whatever that toy is you're buying, where is that money not warehoused just before you invest it? Where did this come up from? 2 nights ago, Diane and I were having dinner, and she said to me, honey, I got to show you this house one of my realtor partners found. It was on the market a couple years ago for $380,000, and today we could buy it for $250,000. It's distressed. They want their money. That realtor tells you about a killer property, and you need to be able to go offer those distressed people $250,000 right now. So you got to have cash available to you, right? Again, the question, where is that cash not warehoused just before you invest it? Well, my money's in the stock market. Probably not, because it's too volatile and too risky. Okay? What about a 401k or an IRA? No, it's not there either if you're younger, because you can't get at it and there's restrictions to going and get it. Well, is it in a CD? Probably not. Why? Because of time constraints and contractual obligations with a CD. So where is that money? Probably sitting, if you've got enough just sitting there to go throw down $250,000. A savings account. And how much is it earning? 0%. But Eric, it's liquid. Guess what? Your money's liquid with a private equity banking account too. It's just earning a heck of a lot more than 0%. So I don't care where you get the money. Like I said, I'm going to share some examples. So here's one for Hugh Jackman. He's just 15 years younger. And he's throwing in $2,000 a month. Because maybe you're thinking, well, how would I get $250,000, right? Well, if he puts in $2,000 a month over 10 years, he'll have $266,000, more than enough to go throw that $250,000 down in the real example my wife gave me this week. All right? That's how you can do it. That can only afford a smaller amount can still get into that. Let's discuss the typical banking methods for buying real estate. As real estate investors, you'll hear us talk about cash on cash return or OPM, other people's money, cash flow, and appreciation. And every time, and this is the key point, every time, whether you pay off a note or you save up and then buy, each time you do that, the key is that you go to zero. Cash is only used once. Thus, when we use cash, the opportunity cost for that cash is gone. You've used it here, you can never use that money again. It's gone. When we couple this with the wealth creator mindset, notice that we have cash value sitting in our cash accumulation account. We've got the insurance company that will give us a loan. So there's 2 pots of money there. My cash value accumulation account, which continues to grow always, and then when I want to borrow money, I don't take it out of my cash value account. I leave it sitting in my cash value account, which is still growing at compounded interest, but I'm borrowing against that, using it as collateral, and I take the money out of the general fund of the insurance company. So I have 2 pots of money. One that will continually grow, and the other which I can borrow and pay back. But this one never, ever, ever. Once you put the money in there, it will never go away. And so this becomes the power when you're talking about buying real estate, is that the portion of my cash value will continue to grow. Now that doesn't mean that I don't have to or can't utilize a traditional mortgage along with it. Think about an investor again. An investor usually puts down 20%. Okay? Borrow that 20% from your cash value from the insurance company, and then use that as the down payment, and then get a regular mortgage company to give you the other 80%. Now you're 100% leveraged, even though the mortgage company really thinks you're 80% leveraged, and it continues to grow. And then toward the end of your life, remember that cash value is a subset of death benefit. And it always will be smaller than your death benefit. So basically when you die, you're going to have 3 to 20x, depending on at what point you die in your health, but probably somewhere between 3 and 20x more value in death benefit than you have in cash value to leave to your heirs. Think about that. You can buy all those toys. Remember that friend of mine that said, well, I can buy cash? Great. Shove it into your cash value accumulation before you buy that car, then go buy the car. Now the same amount of money that you just spent on that new car is inside of a cash accumulation account. Want to go buy a boat? Shove it through your cash accumulation account first, borrow it out of there, and that increases your death benefit. Or the generational wealth that you want to give to your family. Need to buy a plane? Shove more in there. Open up more policies. If yours can't fit it, get one on your wife, your kids, your business partners. Fill that thing up as big as you can and use it for every single major purchase you do. And at the end of your life, your death benefit is going to be 3 to 20x larger than all the spending on toys you've done throughout your life. And it comes back to your heirs tax-free. Back to what I said. I'm going to show you today how to build a predetermined, tax-free legacy for your heirs. And that's how you do it. Who'd have thunk it, right? You're going to buy all these toys throughout your life, and then the value, add up the sum of all those toys, and at the end of your life, your family's going to get 3 to 20x more in generational wealth passed on to them tax-free for all the toys you put through that account. A friend of mine said to me, well, I only planned on putting into this once and then just letting it sit there. And I thought, I haven't explained this well enough, buddy, because the more you put in, at the end of it, you still have access to it. You can still use it. You can still go buy the same toys, but at the end of your life, all of that sum of all those toys will go into 3 to 20x more in death benefit for his family. So if I were making the kind of money that gentleman's making, I'd be buying, like I said, policies on my wife and my kids and any business partner I could, and I'd be shoving as much money through those as I could. That's just me. Let's look at a distressed property scenario. We're going to look at cash on cash rate of return. The first is going to be a cash purchase, and we're going to compare that against using the leverage of our cash value private equity banking account to see the difference in our rate of return. Right? Now, on this one, it'll just be a buy and flip. Okay? So, my wife came in yesterday, like I said, told me she found this property for $250,000 that was worth $380, or at least it was listed at $380 a year ago. So let's say we buy it, we hold it a year, we wait for these high interest rates to go away. They go down, and we put it back out on the market, and we sell it for $350. We just made $100,000. So let me ask you, what's my ROI? Right? What is my cash on cash rate of return on that scenario? So you take the $100,000 in profit, divide it by $250,000 of the cash I put down, and that comes up with a 40% cash on cash rate of return, or ROI. Every investor knows how to do that. Let's do the same. This time I'm going to leverage my cash value private equity banking account. So I borrow that money from the general fund of the insurance company, again using my cash value as collateral, so that one's going to keep growing, and I'm borrowing from the general fund of the insurance company. $250,000 is what the general fund of the insurance company gives me. I wait a year, same scenario, I flip it for $350. Made $100,000 in cash. What's my ROI? If you say 40% and I agreed with you, we're both wrong. Why? Because I didn't spend my $250,000. Remember, it's still sitting in my private equity banking account. Well, what did it cost me to get that money then? And these are my real numbers, by the way, folks. Okay? With my account, I got paid 4.25 last year. And I can borrow at 4.76. So I'm going to get paid interest on $250,000 of $10,625. And I can borrow, like I just said, at 4.76. So to borrow $250,000 is going to cost me $11,900. That's a negative $1,275. That's all I've had to pay. That's what I'm going to pay out of pocket when I resell that home. So if we divide $100,000 in profits by the $1,275 that I had to spend in cash, I just made 7,843% cash on cash rate of return, or ROI. Let that sink in, folks. Just because I used my cash value account, I have improved my ROR, my rate of return, from 40% to 7,843. That's the power of private equity banking. Here's another example. Friend of mine, banking method for leasing his equipment. Here's what the banks would have. Now, this gentleman is not a super rich guy. He does well. He owns an HVAC company, and he had a number of utility trucks. And he had been taught by his CPA to go out and lease those trucks because then it was a company tax write-off. So what he'd do is he'd go lease a truck in year 1, and then in year 2, he'd lease another truck. These are 5-year leases. Year 3, another truck. Year 4, another truck. Year 5, another truck. And then he'd turn in that first one and get his 6th truck. And every single time he did this, he's back to zero. He didn't buy the trucks. He just turned them in and got a new one. So all it was just cash flow going out the door. But his CPA would tell him, but you've got a tax write-off. Let's do that same scenario now, except inside of a private equity banking account. He became his own bank and used arbitrage. He bought the truck for himself, and then guess what he did? He bought it in his name. He probably owned it in another LLC. But whether he bought the truck in his own name as the owner and then leased it back to his company is what he did. So he buys a truck and then he leases it back. And he kept all of these things inside of his private equity banking account. So he's the owner of the HVAC company, and under that he buys truck number 1. Then he leases that truck back to his HVAC company. So he becomes what? The bank, private equity banking. He became the bank to his own company. Let's look at the numbers. His cost of goods, his cost to get the capital. So he can borrow, and the total to buy a $100,000 truck is $510, or in other words, 0.5%, a half of a percentage point. You tell me, how many small business owners can go out and get a signature loan for $100,000 at 0.5% interest? That's what he's able to do. Then he leases it back to his company at 6.5. So he's able to borrow the money at 0.5, and he leases it back to his company at 6.5. Let me ask you, what's the rate of return? If you said 6%, or I said it, and you agree with that number, because that's what most people would say, we're wrong. Let's look at it this way. You can get money for 50 cents, and then you can get back $6.50. What's his rate of return? If you say it's $6, how much did he make? $6? Well, you're right, kind of, because he did get $6, but that's his investment gain. What's the ROI? Let's look at it. It costs him $500. He makes $6,500. It leaves him $6,000 on a year. Again, a $100,000 loan. What is the ROI? 1,200%. What? Yeah, that's how banks make money, guys. Why do you think that they've got the biggest buildings in every downtown area? Because they're making a 1,200% return on investment. He just did that for his own company. I mean, think about that. How many small business owners with an HVAC company do you know that are making 1,200% ROI for each truck in his fleet? That's what this gentleman was able to do. How many HVAC owners are also leaving their families millions of dollars in tax-free legacy? Why? Because they bought every one of those trucks through their private equity account. Again, if you've got the ability to buy equipment or toys and shove them through a private equity account, that's what you do. Because at the end of the day, you're able to leave your family multi-millions of dollars in tax-free generational wealth. What about angel investing? How can you use private equity banking with angel investing? I've done this. A good friend of mine, I worked with him for about 5 years, needed some cash to expand and buy some equipment in his company. It's a private company. He needed about $40,000. My money pays me 4.25, so on $40,000, that's $1,700. And when I borrow it, I have to pay 4.76. So I have a net difference of a negative 0.5. In this case, it's going to cost me $204. It's been 4 years since I invested in that guy's company. Haven't gotten a penny back. How much has it cost me so far? $816. That's it. I hope like crazy that he finally gets his company public and my shares, because I bought shares in his company to do this, increase. But for now, My $40,000 is still in the private equity banking account, and I've only had to pay $816 to lend him $40,000. Are you entrepreneurial types thinking, letting the juices run at this point? Here, let me give you another one. Day trading. I got another friend, does day trading. You're just watching them candlesticks. Let's say he wants to throw in and risk $40,000 on day trading. What's it going to cost him? $204 for a year. I've got another friend who does this. He goes out and buys distressed vehicles. He's prior military, and he was disabled, and so he gets a paycheck every month just for waking up. And he's got a son who has disabilities, and these two gentlemen drive around. And he goes to auctions where he can pick up equipment that was vehicles that were taken in drug raids and things like that. He bought an RV that was about a $250,000 RV for $100,000. And before he even picked it up, he had already sold it for a $100,000 gain. Okay, where did he get the cash? Bingo. How much did it cost him? 2 days worth of money? You know, again, you got to have the money readily available. Back to that question, where's your money not sitting before you use it? This next example will be a buy and hold real estate example. We're going to be looking at cash on cash rate of return. In the first instance, we've got a cash purchase of $150,000. Our rents are $1,200. So yearly, we're making $14,000 in rents. How do we get our ROI? Simple. $14,000 in annual rents divided by the amount of cash we put down, $150,000, gives us a cash on cash rate of return of 9.6%. Versus using leverage with my own cash. So all I'm going to do is now leverage this 5 times, still using up my cash. $150,000 purchase, $120,000 mortgage, $30,000 of my own cash, which is 20%, right, of the purchase price, and $1,200 again in rents, less my mortgage, $720, that's at 6% by the way, and a $480 cash flow monthly or annually, $5,760. So if we divide the $5,760 by the $30,000 of my cash, that gives me a cash on cash rate of return of 19.2. So just by leveraging other people's money, we get a 19.2 return on cash return instead of a 9.6. 5,760 in rents divided by 30,000 again is our 19.2 cash on cash rate of return. But we can do this 5 times now. So 5 homes times 5,760 would give us 28,000 in rents. 28,000 in rent divided by the 150,000 that I spent to get those 5 homes would still give me an ROI of 19.2. But notice that we've now doubled our cash flow from 14,000 a year to 28,800. So we've doubled our cash flow. Now I'm going to run through 2 more scenarios. These same 2 with the leverage, once using net instead of gross numbers, and we'll see what it does. It says leverage with private equity banking, which is what I'm going to show. But first I'm going to begin by showing the leverage with my own cash, and then I'll show it with the private equity banking in a net type environment. Okay? $150,000. I've got my $120,000 mortgage, and $30,000 is my down payment out of cash. Now I'm going to throw in expenses, so this is more of a net environment. $719 is my mortgage. Let's say the property taxes are $100, the insurance is $50 a month, and the maintenance, let's just, because it's an investment property, throw in another $50 a month for maintenance. Okay? That gives me a rate of return of 10.9%. All right, now let's throw in the same monthly expenses, but we're going to throw in the property appreciation of 3%. Now I'm going to go back to 0 for the rest of them, but just so you see what it is, when we throw in the appreciation of just 3%, it takes our rate of return up now to 20.8. But I'm going to take that out of this equation because we don't know what it's going to be in every market, okay? Back to then the property value of 0 at 10.99. And what we've thrown in here now is the net monthly cash flow of 281 versus what we used to have of 480 on the gross. So our net now monthly income is only 281 because we've put in those other expenses. $30,000 down. Back to the question, where is your cash not warehoused just before you invested it? So if it's not in the stocks and it's not in a 401k and it's not in a CD, it's probably in savings making 1%. And this is where we get back to, again, the same kinds of values that we get from a private equity banking account. So I'm going to take now that 30,000, instead of having it be my cash, I'm going to borrow it. Okay? So now you'll note that I've got the 150 and I've added here one more expense, $4,000 for closing costs. Now the down payment is $34,000. That takes my ROR back down to 7.1. But what happens when I move that $30,000 down payment out and make it a second mortgage by borrowing it, and all I've got is the closing costs? That's all I'm paying, or the closing costs. And again, I'm keeping the property appreciation at 0 for this. So the second mortgage, which is really just borrowing or leveraging my private equity banking and taking a note from the insurance company using my cash value as my collateral and taking a second mortgage from the insurance company of $30,000, okay? And putting that at 5% because that's just an average in many of these companies. You already saw with mine, it's 4.76, but we'll just leave it at 5. That takes my ROR now up to 26.4%. See how we went from 10.99 to 26.4 just because we leveraged our private equity banking account. So let's just summarize this. Leverage with my cash, where I'm paying my own cash, $5,760 in rent versus the $30,000 that it cost me to put my own cash down, gives me a cash-on-cash rate of return of 19.2. But again, I can do that with 5 homes, and we saw that the rate of return doesn't change. Still gives me an ROI of 19.2. Now what happens when I leverage my private equity banking? $5,760 is still the same amount of rent, but I only took the $4,000, remember, in this net equation for the down payment, and the $30,000 I took out of a note. My cash-on-cash rate of return jumps up to 144%. And it's the same again with $28,800 in rents for all of those properties with only $20,000 out of pocket. So again, I'm only risking or putting out $20,000 of my own cash, and I'm borrowing the rest of it to get $28,000 in income. So my ROI shoots up to 144 instead of the 19. And in both cases, I double my cash flow. All right, next example, and I really like this one. This one is a business owner, and we're going to look at how they protected their business assets, how they paid off a structured loan with an unstructured loan, and how they're now leaving their family a tax-free legacy. These are some friends of mine. They had a small retail establishment, and they rented or leased the building. After, I don't know, maybe 20 years in business, they had the opportunity to go and purchase a building of their own, which was very close to the other, but in a much better location. Just down the street, but in a much better location. So they bought it. One evening, my wife and I went over to some other friends, and we were just sitting around playing board games. The husband stated that he was concerned. He had enough cash to pay off their mortgage, but they were looking at retiring, and they were thinking they didn't want to give up all their cash, yet at the same time, because they wanted to retire, those two leaving this family business, they were going to have to hire 3 more employees to take the spots that those two were in. So it was going to cost them even more money because they had to hire 3 new employees. And they were concerned about using up that much cash when they weren't sure what the cash flow in their little business would be by hiring 3 new employees. Also, the husband was very concerned about our economy. He was worried that if he had this mortgage when he retired, that would be hanging over his head, and the company would not only have to make enough for the 3 new employees, but also to pay off the mortgage. So these were the things that we were bantering about as we were playing games. And I suggested, I said, hey, well, you know that you could take that money and you could throw it into a cash value account, and you could do what we call a 2-pay, where you make 2 payments is all, and then you let the earnings from the policy continue to pay out after that. And after the second year, you'd be able to then take that cash, borrow against the value of that cash, take it out, and pay off that mortgage. Now that mortgage, instead of being a structured mortgage with a typical mortgage company, would be with the insurance company, and you'd never have to pay it back. You can, so you could continue to allow the rents from your business to pay down that mortgage, but if we got on tough times and having 3 extra employees was tight that month, you wouldn't have to worry about being foreclosed on your mortgage. You just wouldn't have to make a payment that month. Wow, they thought that was great. So here's what it looked like. They put in $165,000 in year 1, and then 13 months later, I know it's the second year, but it was only 13 months later, they were able to dump in another $125,000. They had this money in cash, as I'd said, and they were going to just dump it to pay off the mortgage. Well, 13 months later, they needed about $220,000 to pay off that mortgage. And that's what they did. They pulled out of their net cash surrender value $220,000. They paid off their mortgage. Also note that in so doing, we put this on the wife because she was a little younger, and being a female, she gets a better cost of insurance. It doesn't cost as much for women as it does men. So we use the wife instead of the husband. And she gets now a death benefit of $2.3 million. As I said, look at this part here, paid from premium values. The premium then gets paid over the next 5 years out of the premium values. In other words, the interest rate that they're getting paid on this account is going to take care of that $40,000 payment. They don't have to put it in, it just comes out automatically. All right? And so at the end of 7 years, the term insurance that we bought for them, and we had to do that. That's one of the tricks we do, is we put in a little bit extra term insurance so that the IRS, remember this is all IRS sanctioned, one of the reasons why the IRS is willing to let us do this is because it still has to look like an insurance policy. And that's where the crafting of this becomes important for a practitioner like myself, is to balance the amount of term insurance that's tucked inside of a whole life product so that you can get the bigger cash value out of your policy, right? So it actually acts as a bank account, but according to the IRS, it isn't. It still looks and feels like an insurance policy. So you'll note there that in year 7, she goes from a death benefit of $1.9 million to $497,000. So basically $500,000. Think about that. She was able to pay off her mortgage, and at year 7, she has $229,000 in cash value. She paid off her mortgage, and she still has all that. And note that this continues to grow. So in year 10, she has $264,000 in cash value and $517,000 in death benefit. At the 15th year, when she'll be 72, she'll have $334,000 in cash value and $574,000 in death benefit. And at year 20, when she's 77, she'll have $419,000 in cash value and $642,000 in death benefit. Same amount of money was spent, except now she gets a free death benefit to give to her family, on top of whatever other insurance that they already had, which they did have. Next example. Here I'm going to show you how to pay off bad debts. We've already seen how you can leverage this to have good debt. Now I'm going to show you how to pay off bad debt and build wealth. This couple here, the wife had a very good job, and these were their debts. Notice that these debts were going to last them for 29.4 years, and they had, a couple credit cards, a couple vehicles, and a personal residence, like most families. Because she liked all of the frequent flyer miles that she got with her card, she basically used 1 or 2 of those cards, and she'd run them up to 10 grand each month, and then she'd pay them off. So she had the cash flow. She didn't need to be in debt. She was just using it so she could get the points. But be that as it may, her current debts when I met with her were the ones that I'm showing you there. And they came out to $530,000 in debt. And her minimum monthly payments then were $75, $120, $125, $610, etc. And her monthly payments came out to $3,765. If you look at that number of the total debt of $530, you might think that that's what her total debt is. But if she pays it off during the 29.5 years or 4 years, she's going to end up spending $833,000 on interest only. That, in my mind, is bad debt. Right? 30 years, bam. So here's what we did. We built her a policy where she put in $4,000 a month. That was about what she was paying on her credit cards each month anyhow, over and above what the regular price was. So I said, okay, you'll keep the $3,700 and you'll take that extra $4,000 that you're paying, and now you're going to put that into an insurance policy instead. Here's how it turned out looking like. She was 36 years old. Her annual premium was $48,000, so $4,000 a month. Again, that was what she was already spending on her notes. Cash value, first year, $30,000, and a death benefit of $1.6 million. She ends up borrowing money from the insurance company and using her cash value as collateral to pay these off. And at the end of the year, she still owed $13,299 in loans, and she had paid off a number of those debts. I want you to see something else here, cash value growth. In year 1, she had $30,000 in cash value. In year 2, she ends up with $36,680. So she put in 48 and she's got 36. In year 3, she puts in 48 and she gets 48,430. So it only took 3 years for this thing to start generating more cash value than what she put in those first 2 years. But remember, it's buying her death benefit. She has a good death benefit. Year 4, puts in 48, gets 50. Year 5, puts in 48 and gets 53,000. Year 8, She's been doing this bouncing back and forth for the first 3 years, paid off everything except for the house in the first 3 years. Then in year 8, she goes in here and notice that she has $380,000 in cash value, and she borrows $307,000 of that to pay off her home. Now she still has, that's a structured loan, by the way, obviously, because a regular mortgage. So she had a structured regular mortgage at 3.8%. She pays it off, though, with this. And at the end of the year, still paying in that same amount of money, she has $285,000 left on that mortgage to the insurance company. So look at how that's working for her. She's able to earn 4.25, cash value of $380,000. That's what she's earning her interest on, which comes out to $16,172. She's borrowing the money at 4.76 over 285 of it, right? And therefore, she's going to owe the insurance company $13,583. There's a positive value between those two accounts of $2,588. And she exchanged it for an unstructured loan at a net effect of 0.5. Who can get a loan these days at 0.5? Not 5%, 0.5%, right? So that's what she wrote off her home with. Note that she still has a debt to the insurance company for the next 7 years, and she'll at that point be completely debt-free. But she's moved her loan from a structured environment to an unstructured environment, thus protecting her family from what? The unexpected. Every time that she made a payoff, what she did, she started with the $4,000 and she wiped out that first credit card the first month. Like I said, she was already doing that. She'd run her card up to 10 grand and she'd pay it off. It didn't matter to her because she made enough income to do that, but that was one of her debts when I talked to her about it. So she actually paid it off the first month with her own cash. But that freed up now, instead of the $4,000, now she had $4,075. Then over the next year, she paid off 3 more debts, and that freed up another $400 in monthly payments, right? So now she's got $4,400 to keep paying. During the next year, she paid off 2 more, and that added another $1,142 and took it to $5,142 that she now has to pay toward her debts. Finally, she gets to the point where, as we just saw, in year 8, she's paid off her home. Now she has free $7,764 a month to keep doing this same game with. In year 8, let's summarize this. Paid off the loan to the mortgage company, the structured loan. She now has an unstructured loan for $285,363 to the insurance company. She has cash value in her insurance policy of $380,000. She's freed up $7,764 a month, the $4,000 that she chose to put into the policy, plus the $3,764 that she was paying toward her debts. And as I said, now notice that she's going to pay this off. So she's going to keep throwing that $7,764 against the note that she has with the insurance company for the next 7 years. So in 15 years, she's now paid off her loan to the insurance company. Keep in mind, she wasn't going to pay off that mortgage for 30 years. And she has a cash value of $855. And she's what? How old? 50 years old? $855,000, 50 years old. Obviously, we're going to expect her to live more than 50 years. So what happens at age 51? She has $935,000 in cash value and $3.6 million in death benefit. I also want to point out something else. Here at age 20, notice that she quits making any payments anymore and that her death benefit drops a bit. Why did we make her death benefit go out for 20 years when I had said earlier that the IRS usually only makes us go out about 7. Well, when did this young mother start her policy? When she was 35. She had young children at home. And so we still craft these around your specific needs. She wanted to have a little extra death benefit during the first 20 years of her children's life, just in case something happened. This is all created individually for you. Also note that 2 years after she hasn't made a payment into this policy, her cash value increases by $56,000. Tax-free. Not bad for a 56-year-old to get $56,000 just for waking up. How about at age 65? Now she gets $77,000 just for waking up. Hasn't put a penny into this thing in 10 years. And she's got $1.9 million in cash value and $3.9 million in death benefit. 65 years old. What could she do at 65 years old with nearly $2 million? What could she invest in? What could she go do with her husband? A lot of things. All right. Tax-free income for the rest of her life. Let's say she wanted to pull out $100,000 tax-free for the next 20 years. That would be a loan of about $2 million, right? And she'd still have greater than a $4 million death benefit. The net death benefit would then be $2 million, so she'd still be leaving a $2 million legacy to her family. Tax-free retirement and a tax-free legacy. Let's look at a couple age markers there, 70, 75, and 80. At 70, she has not been paying into this policy for 15 years, has $2.3 million in cash value and $4.2 million in death benefit. Age 75, she hasn't paid anything into this policy for 20 years, has $2.9 million in cash value and $4.5 million in death benefit. At age 80, $3.5 million in cash value, $4.9 million in death benefit. Do you see the power of tax-free retirement and tax-free generational wealth? You get to choose what that will be. This next example will be with Julia Roberts. Now, Julia was paying in the max she could into her 401k, $55,000 a year. And she wanted to know what it would look like if she quit paying into the 401k and started putting it into a high cash value insurance policy. Also, at about the same time, her parent had passed away and she had inherited about $90,000. And so what we did is in year one, we threw in $145,000. After that, you'll note that she's going to keep paying the $55,000. Also note that in the very first year, she has a total net cash value of $125,000. She could use that to buy a car. She could use that as a down payment for a home, whatever. All right. The next 10 years, she puts in the $55,000 a year. And note what her total net cash value is, $738,000, and her death benefit is $5 million. So to recap the first 10 years, she puts in a total of $640,000. She has $738,000 in cash value, and she has a death benefit that's grown from $3.6 million to $5.1 million. Let's take her a little further. Also note, at age 61, she's going to drop from paying $55,000 a year, and she's going to put in just over $1,000 a year for the next 5 years. Her goal is to retire at age 65. Recap, ages 40 to 65 while she's putting in. Total deposits, $1.25 million. Total cash value, $2.357 million. Total death benefit, just over $5 million. Now, watch this. This is where she begins to retire. She wants to take out $135,000 a year tax-free. Once again, you sit down with me and you say, Eric, I want to be able to take out $70,000 a year tax-free. I want to take out $100,000. I want to take out $135,000. I want to take out $500,000 tax-free. I don't care what the number is. We'll build something so that you can get there. And if you can't do it inside of one policy, don't forget, you can do it with your spouse. You can do it with your kids. You can do it with your business partners. We can build you what you want because you can be the owner of multiple policies. You just have to have enough bodies there that you have an insurable interest on, like family members or business partners, to do this. So in her case, $135,000 coming out per year tax-free. Also note, her total net cash value. It has grown up until age 65. Now we're going to start pulling some money out. Let's see how long this will last. Note that between age 66 and 67, she goes from $2.3 million in net cash value to $2.28 million in net cash value. It only dropped by $39,000, even though she pulled out $135,000. Why is that? Because her total cash value continues to grow. Her net cash value is going to now begin to slowly shrink. Why? Because she's borrowing against it, right? And so the net is all the loans versus the total. And so that's going to start shrinking. But notice she pulls out $135,000 and it only goes down by $39,000. Let's see what happens after 10 years. Note that after 10 years, she has a net cash value of $1.9 million and it is reduced to $1.869. So $61,000 less. She pulls out $135,000 and it only drops by $61,000. This is what's happened during the first 10 years of her pulling out $135,000. 1.35 million she's taken out in 10 years, and it's only shrunk her total net cash value by 450,000. How long can you do this? Folks, add a zero, subtract a zero. I don't care. The math will be the same. You can prepare for retirement tax-free with one of these policies like nothing else. Oh, and think about that. Remember, this was against a 401k. If she had been pulling out $135,000 a year from her 401k, what would have happened? She would have been paying taxes on it. Okay, age 90. 25 years of this, $135,000 a year for 25 years. Note that column there. Contract premium. You see, every year, the gains on this policy are paying her actual premium for her. And note that that premium has never changed. She's 90 years old. She quit paying any premiums herself at age 65, 25 years later, and her premium is still the same. That's the magic of whole life. You try to do that with term life or an IUL, it wouldn't work because term and IUL both have a cost of insurance that goes up every single year. And so the cost of insurance will outstrip any gains. That's why I use whole life and not an IUL. But that said, let me ask you this. Do you think that you could get a 90-year-old $13,500 a year and get a $4 million policy at age 90? Never happened. Total net cash value, let's see what happens here at age 85. It still only drops by $119,000. And finally, at age 90, it drops by $163,000, her total net cash value. Let's recap what has happened here. During the first 25 years while she was working, she put in $1.25 million. She had access to that cash anytime she wanted. She wanted to invest in a house? She could have. She wanted to buy a car? She could have, right? She wanted to buy a speedboat? She could have, right? And then she could have paid it back or she could have not paid it back. But she put in $1.25 million in deposits and had a cash value there of millions. And then what happens? She goes into retirement and she starts pulling out $135,000 per year for 25 years. So she's pulled out $3.375 million over the next 25 years, all tax-free. If she'd have been working, what would have that cost her? Do you think she was a financial burden on her family, pulling out $135,000 a year? I think not. Generational wealth. One more thing we promised. What would have happened if she had passed away at age 81? Well, she would have left her family almost $2.5 million in death benefit. Again, that's her net death benefit. Her death benefit is still bigger, but they're going to subtract out the loan. What if she had made it to 85? $1.86 million she would have left her family. And even at age 90, she's leaving her family $926,000. Folks, this is what private equity banking can do for you. We've gone over many of the tools. 1, get out of debt while using other people's money wisely. 2, outperform the stock market with zero risk. 3, pay off structured loans with non-structured loans and lower your interest rates. 4, protect your business and your business's assets from an unpredictable and uncontrollable events. Your real estate, your vehicles, your boats, your cars, your planes, your equipment, all of it. We've also shown how not to go and use cash and take your cash away and lose your opportunity cost. Use arbitrage instead. Use your money twice. Very powerful. Invest in real estate with higher rates of return and lower risk. You can also invest in businesses and new businesses and get higher rates of return with less risk. This is probably the most important, well, next to the most important, I guess. Build a predetermined, tax-free retirement income for you. I know a lot of people think insurance is for once you die. You just saw 2 examples where these people were able to build a predetermined, tax-free retirement income. And then also build a predetermined, tax-free legacy for your heirs. This is what you get with private equity banking. I look forward to helping you. Get a hold of me, let me show you, let me craft with you something that fits your goals, your finances, and your health so that you and your family can take advantage of private equity banking. I look forward to helping you. Thanks.